for these young traders, it's almost like they're taking some risks. Maybe it's their play money. But as they get older, the narratives here seems to be the investments are going to change, the assets are going to grow, and you'll see more and more investors put their money into plain vanilla ETFs, for example. Do you buy into this kind of narrative?
Yeah, totally. You think they're probably their primary account is their 401k, and this is their money. It's part of their savings. They're using it as their play money. I don't think you should overlook the fact that fractional shares have really changed the business. It used to be, you had to go out, you had to do a minimum, you had to buy X amount of shares at a brokerage firm. Now you can go in, you can put $50 in to buy, a share of Tesla or a part share of Tesla. I think it's really important, and it also gives you a way to diversify the account. And I think, as Andy said, as these accounts get more mature, you're going to see us start diversifying into more of the pure bread and butter ETFs with the alpha generating areas on top of it.
It makes total sense to me, Harry. I mean, in terms of what they own here. Cathie Wood, they love Cathie Wood. That makes sense. Cathie Wood's a hero amongst some of this group. No surprises there. I think Tesla is the #1 stock held by people under 30 or something like that. She is a leader in Tesla, so they tend to follow it. So Harry, nothing I'm seeing here is shocking to me particularly.
No, it all makes sense. You have to say, look what happened during COVID when people were from home. You saw a massive uptick in people doing online investing. ETFs were part of it. Individual stocks, as Andy said. All of the GameStop type stocks, Avis, Hertz, all of that stuff that's going on in those marketplaces. It's just the future. The future is these types of platforms.
Yeah. Anthony, I wonder if you could just tell us a little bit about whether most of your clients have accounts elsewhere. Maybe you can clear that up for us. Are there other long-term assets and accounts sitting elsewhere, like ETFs, for example, or other kinds of accounts that are just not on your platform?
Yeah, it's so with the demographic of user, and I'm talking about traders, in the late 20s, early 30s, that are most prolific on our type of mobile-first brokerage solution, like a Webull, like a Robinhood. It's very common for them to have multiple brokerage accounts and multiple relationships with different sort of tools. Because again, these are all mobile app based, right? It'd be different if we were back in the brick and mortar days where it was a bit more common to have one specific asset manager down across the board where they're doing your retirements, they're also doing your active trading, they may even be doing your banking. Those days are completely gone with this new Generation Z or millennial type of customer, right? They look for different platforms that offer better things for their individual needs, whether it's improving their credit score, whether it's free checking, free trading with access to options and crypto at the same time. And every platform does one thing a little bit better than everyone else. Now, everyone tries to create that one super app, right? But one size never truly fits all. And it's really easy for today's user to have multiple relationships and to manage those relationships easily. Minimums are gone, right? Minimums used to be a thing, or if you didn't trade enough per quarter, right, your account would be put in hold or put on lockdown. Those things no longer exist. There's no more minimums. There's no more expectations for you to have a certain amount of deposits per year or a certain amount of transactions per year. So it really opens up the playing field. And we're seeing a lot of our customers may actually be holding a lot of ETFs, especially in these robo-advisor platforms like a Betterment, right, or a Stash or an Acorns, where they actually are very ETF heavy in their portfolio, but on their active investing platforms like a Webull, they're more stock specific, right? They're taking those opportunities to create that alpha in their portfolio to get some incremental cash.
And not only
it's almost no different than cable, right? Than cutting the cord and doing streaming. Like, you have the choices. Exactly. You don't need the bundle.
Disney Plus and HBO Max, and we have them all. We all thought we were going to save money by cutting the cord.
Yeah, and it's not only there's no minimums, there's no commissions either, right? You're not charging commissions, are you? You do payment for order flow, right?
We do payment for order flow. We do allow fractional trading. We allow options trading, complex strategies, calendar spreads, condors, no contracts, no contract fees, no commissions, no minimums, no monthlies. It's a no-cost platform to our customer, and we do make money on payment for order flow to monetize.
What I think is worth noting too is that this generation has a different appetite for risk from the bottom up. if you even look at the employment, we recently launched a private equity business, and what we're finding out is that there's so much more liquidity and things happening in the private equity space because the younger generation of employees, those reaching their 30s and 20s, exchanged equity in the company for lieu of a salary. And there is a ton of risk. And I'm working for a startup. I'm going to take 50% of my salary in equity and watch this thing go public in 10 years. That's happening way more than it did with the 40s and 50s and the baby boomers that are happening now. So they're just used to risk, and they're also used to being very educated about it. I think it's great what Webull's doing with all the education, the options.
Yeah.
There's so many more tools available now for the education.
Yeah. Andrew, Anthony was talking about their investors being on multiple platforms. So it seems like a lot of these young people have private equity exposure through their own jobs, for example, in new companies.
Yeah.
And that's a growing trend as well, right? You're seeing that.
Yeah, that's what we're seeing, because all of a sudden, like all these companies, I mean, you'll hear about it. You guys have talked about it and say, oh, can I get into Palantir early and DoorDash and all these things? And this is why the SPAC's coming up, right? The popularities, everyone wants to get in now. They want to be like their grandfather's Goldman. He was the best account, so he got in pre-IPOs. That is not what goes on anymore. And the reason why there is liquidity is because you may have a 20-something that is a C-level executive at this company, and he has so much that he wants to get out. I've talked to these companies, and they're like, yeah, sure, we will let the CFO let go of $10 million of this company. He's been in it since he was 22 years old, and they get to cash out. That's a new phenomenon. Obviously, it's not related to ETFs, but it just shows you that, of course, they're willing to write a call, sell a put. That's nothing compared to they put in the entire risk of their career on one company. So they like to diversify. They do these other companies. They get involved early. They're not scared.